Biden announces a 6 trillion budget and markets don't flinch. Vols absolutely collapsed back to levels not seen since February 2020. And gold powers higher despite the flat dollar. All this and more in this week's Macro Insight. Okay, so welcome back to Macro Insight. Today's the 1st of June, and let's see what's been going on in markets. So last week, it's been very quiet, right? You had the only real major news flow was Biden announcing his budget of like 6 trillion. But that headline number is just a little bit sensational. I mean, the market hardly flinched on it. There was very little reaction, both in bonds or in equities. And from what I've read, it's expected to be watered down. The number's probably going to be more like 3 trillion. And, nothing's going to pass until after probably August, September time. So markets kind of have really just taken that with a pinch of salt for now. And then if we look at price action, really, the S&P just traded in a really tight range last week, right? So S&P was in a 1% range all week between 41.80 and 42.20. And that, and yields just consolidating, doing nothing despite the high inflation prints, right? So we had, so you see here, we had a pretty big PCE, and PCE being, the Fed's preferred measure on inflation, and that came in year on year 3.06 and month on month 0.66. And the bond market, if anything, rallied, right? So just kind of tells you what the bond market is thinking or feeling about inflation right now, right? Base effects well known, short-term inflation well known, and then really the question is it transitory or not? And yeah, certainly the bond market reaction so far is suggesting it probably is going to be more transitory. So if you look at inflation markets, here you've got US 1 year forward inflation rates. So you've got 1 year inflation swaps, and then you've got 1 year inflation swaps, and 2 year 1 year. So these are telling you what the prediction is in the future of where the 1 year inflation will be. And you can see the green and the blue much, much lower, kind of at their normal sort of levels. And it's really only the 1 year inflation that's kind of up there on the moon near 4%, right? So inflation swap markets also telling you that they seem to think that the Fed is right and it probably will be transitory for now. Yeah. So that's, and as a result, you've seen, equities and other markets kind of react. You've seen obviously tech stocks recovering a little bit. Some of those meme stocks and those high growth, low earnings stocks have recovered as well, like the ARK ETF and things like that. And that's really on the back of this narrative that inflation is most likely transitory for now. Okay. Let me bring up the charts. So we were in that 1% range, as I said, all week. And then we're popping our head above there today. So 42.27 currently we're showing on S&P. So S&P may have a little charge up towards 42.50 in the short term. I think that will probably act as a bit of a resistance short term. 42.50 again seems to be an area where the street owns a bit of optionality, which is probably going to provide some overhead resistance in that area. We probably would need some sort of reason, some sort of strong reason or strong sort of catalyst to break out of that in the short term. I think one of probably the most important signals to really look at is what vol's doing, right? And so if you bring up the VIX, the VIX has absolutely collapsed to levels, back to like February 2020 levels, right? We had a 15 handle on the VIX. Realized vol absolutely collapsing as well. 10-day realized is sub 10. What happened there? If I bring up the VIX, so you see here on the VIX central page, you've got front month VIX at 18.5, and realized numbers, 10-day realized 9.18, right? So absolutely collapsing, street getting supplied. Now, generally when the VIX collapses like that, it's an indication that the street is getting hit, it's getting supplied with more and more volatility, right? More and more options. So that's what you should kind of read from that. And that kind of also tells you that the odds are we're likely to see a relatively quiet, at least next couple of weeks into the next major expiry, which is third Friday of June, because the volatility reaction is giving us a read on volatility positioning, basically, right? And if the street is just sitting there long loads of vol, it's going to make it quite hard for the market to move anywhere. Yeah. Another sort of anecdote on the vol side is skew is quite expensive, skew is quite high. Skew is the relative pricing between calls and puts. And when skew is quite high, it means that institutional money, institutional flow has been buying puts and selling calls. And so they are well hedged. They're well hedged for any kind of correction. So any kind of big, deep correction is probably less likely because the end user clients are kind of ready for it and positioned for it, basically, right? So those are all, for me, indications that we're probably not going to see any crazy volatility in the next sort of week or two, at least. Yeah, and we may end up having a really boring summer through June and July, which we'll see. Yeah. If we go back to some of the other markets, I mean, the DAX is doing pretty well. Europe kind of taking out its highs. Had been mentioning I was relatively bullish Europe equities of late, and yep, back through the highs, back through those recent highs. DAX sitting at a local high around 15, just shy of 15,700. Like I said, I've been playing this through EWG calls to July. So when that opens up later, I'll see where that is. But obviously that's going to be through its highs as well, given where the euro is. And then you've had a bit of decent price action out of China. I've been saying, China was looking like it was a bit of a buying opportunity over the last few weeks. It'd been consolidating for a couple of months after that, decent correction on the back of all the Archegos hedge fund blow up. So that was an opportunity to sort of dip your toes into China there. If you thought, that was going to recover, and it does seem to have started to do that, right? And some of those China tech names are starting to recover nicely as well. And then you've also got India. Obviously, India was having a tough time with COVID over the last couple of months, but as we flagged, that doesn't necessarily mean that the market's going to be weak. And often peak lockdown signals the local bottom in the market. And that's pretty much exactly what happened in India. And Nifty is back to its local high, right? So I'm still long that. For me, it was a bit of a longer term hold, that one. But I wouldn't be surprised actually if in the short term it had a little bit of a pullback. Now that it's starting to, we've reached the peak, and maybe some of that is priced in now. But for me, I'm not in any rush to exit that position. I think that's still got legs over the longer term. Yeah. So, and I think EM in general may well be what provides the leadership to equities over the summer. So whereas the US might kind of grind very slightly higher, but not do too much. And Europe might continue, but I think some of that European recovery story is now getting quite well priced in. I think EM may well be your opportunity. So you bring up the EM ETF here, there's a bit of a level here at 55 and a quarter. If that breaks, this thing could charge back towards its highs at around 59. And China makes a decent chunk of that ETF, that EEM. So I think, if you think the China recovery in equities has kind of begun, that's probably not a bad spot. Playing call spreads in EEM, maybe slightly longer dated ones like August or September. Playing call spreads there might be quite a nice risk reward opportunity to get exposure to that if you think that makes sense, that EM is going to be the one that provides a bit of leadership. And also the dollar is going to be important for that trade, right? So if the dollar remains weak, which it kind of is at the moment, and it's threatening those long-term support levels, then I think EM will do well on the back of a weak dollar, right? So something to have to think about there. Okay, so that's kind of the equity outlook. Today's going to be a relatively short call because there's not too much happening. In terms of the data, relevant data out this week. We've got some ISM manufacturing in the US today. We've got services, ISM services on Thursday, and then we've got non-farm payrolls on Friday. Non-farm payrolls, probably the most important one of those, but even that one, you know how noisy that number can be. I mean, last month's number was meant to be 1 million and it came in at 250K. Now, that shocker of a number was put down to things like the stimulus checks and unemployment benefits were incentivizing people not to look for work. So we had a really high job vacancy number, job openings numbers, but you didn't have actually many payrolls because people would rather stay at home and not actually work because they don't need to. It seems that a lot of states in the US are basically stopping those unemployment benefits because they want to force people to get back into work. I think that might not be in these numbers this month. So I think we're more likely to see that in June, July, August, the effect of that. So we might actually see another kind of shortfall in the number. I don't know what the expectation is for this Friday. I haven't checked, but we may get another relatively poor number this month. But I don't think the market's going to take it that badly because of what we saw last month and the kind of logic associated with that, right? So until we've got these factors that are distorting the labor market, like the unemployment benefits and stimulus checks, until we get rid of that, it's going to be hard to see what the true sort of deal is in the labor market, right? And we're going to see that probably later on in the year, sort of in the autumn. Yeah, so that'd be, I think it would continue to be a noisy number, that non-farms number. Okay, so if we now talk about FX, pretty dull in FX, right? I mean, I'd been saying that the dollar, you know, was doing a bit of coiling action and was looking like it was going to test the long-term support. Hasn't done a lot. It had a very small bounce up to kind of 90.5, close to, and then it's faded straight back down again. For me, the big area is still 88, 89 in the DXY. That's the area where it's likely going to test. If it takes that out, I mean, then it's curtains for the dollar. It's going to 84, I think. And that is longer term where I think it's kind of headed. But, you know, I'd be surprised if once we drop down into that zone, we don't have some sort of reasonable bounce off that zone, right? So I think over the next couple of weeks, maybe we get general weak dollar, quite bullish sentiment, quite risk on sentiment, kind of takes the dollar into that zone, takes equities a little bit higher, takes EM higher, things like that. And then at some point in the summer, we get a bit of a bounce in the dollar and maybe some sort of short-term wobble in risk assets as well, maybe in commodity markets as well. But for now, I think the kind of path of least resistance is it kind of drifting lower. Yeah. If we look at the other currencies, Euro obviously hanging around 122, not doing much, just the flip side of the DXY. Cable's been interesting. It's kind of threatened to break 142, but is struggling with it, not really managing to. It's quite a big level, this 142, 142 and a half on a longer term chart. If it takes out 142 and a half, then it's got legs to about 144, 145 quite quickly, I suspect. And then maybe even 150 by the end of the year. So that's one to watch. I'm having a look at that. I might see if there's any interesting kind of call structures to play in the FX market to year end to try and get some exposure to that break if that break comes, basically, right? So it's maybe something like selling a 144 to buy a 148 call ratio, something like that, to play that break higher in cable if it comes, right? The pound seems to be doing pretty well, just given the UK vaccination rollout has gone particularly well. They're talking about 75% of the population having 2 doses within the next month. And, you know, the central bank going to maybe start talking about tapering and hiking rates by the end of the year. So whereas the Fed doesn't seem to be on that same sort of trajectory, right? So, yeah, that's something that's driving cable. Okay, in terms of commodities, what's going on there? As I mentioned, oil's, you know, had its little blip down on the talk about Iran, maybe being able to get rid of some sanctions if they can agree something on the nuclear front. That doesn't look like it's going to happen anytime soon. And then you had OPEC yesterday talking about a relatively tight market in oil. And so we had this thrust through that 67 area, and popped ourselves to 68.5 now. For me, 68 was the level to break. It's taken it out. I've taken a little stab on oil here from the long side to play this break. I think it opens up the way for maybe 75 over the coming month in oil. So let's see if that happens. I mean, I'll run a relatively tight stop on it, probably somewhere around 66. So if it breaks back below 56, then I'll consider that a false break. But if it is a true break, then there's no reason why we can't get ourselves above 70 fairly quickly. Yeah. So that's where I am on oil. In terms of gold, been pretty strong gold. Hasn't really looked back since breaking that 1860 level, which we said was the key downtrend resistance. Kind of gone up in pretty close to a straight line. Gold has had some repositioning flows as well, right? So you've had hedge funds sort of adding exposure to gold. I think they were a bit underweight. You had some hedge funds kind of add back exposure there. Gold, I mean, my general views on gold were a bit more bearish, as you guys know. And I think, you know, what I got wrong there was that I thought bond yields would go higher. I thought break-evens wouldn't go higher, and I thought real yields would rally. Because I thought inflation markets would look through short-term inflation, look at the longer-term factors that drive inflation, and say, yeah, this is going to be a short-term blip. So break-evens wouldn't move, and I thought the bond market would just get a bit spooked on the inflation numbers, but the opposite's happened. So you've had break-evens go higher on the back of commodities exploding, okay, and obviously the higher prints that we're seeing on inflation beating expectations. So you've had break-evens trade higher on that, go to multi-year highs, and you've had the bond market just sit there and do nothing. I think that's explainable by the fact that the market kind of believes what the Fed is saying, that they believe it's transitory, so they're not going to do anything on rates for a long time, okay? But also, I think probably the bigger driver is that foreign buyers of treasuries, right? So I reckon the reason bond yields in the US haven't rallied that much in line with what inflation expectations and inflation break-evens have done is because the likes of Japanese and European pension funds can see US yields as pretty attractive, basically, right? Relatively. So I think that's a big driver of that, right? So anyway, what happens next remains to be seen. I mean, given how the bond market's reacting to super high inflation prints, it seems like the bar is pretty high for any inflation prints over the next 2 months to really rock the bond market. So you'd have to assume that the bond market yields are going to stay relatively range bound or kind of contained. Then the question is, what do break-evens do from here? God knows. If commodities continue rallying, then maybe break-evens follow that, right? Now, there is a case for commodities to continue rallying, right? So if I share this screen, something interesting about commodities is that this 1 year implied carry in the futures of commodities, right? So to have exposure to commodities, a lot of funds just sort of buy futures, and obviously they have to roll those futures. So the moment the futures for a lot of these commodities like oil, like nat gas, copper, etc., they're all in backwardation, right? Because of the tight market. And so that means that you hold your futures, you hold your front month futures, and then you roll them into a cheaper future. And then that goes up, and then you roll into a cheaper future. So there's a positive carry to being long commodities. So in theory, that should be quite supportive of commodities in general if there's a positive carry implied into those futures curves. So maybe, you know, commodities have still got some legs to keep going higher over the summer, and maybe break-evens trade higher on that. If that happens, then that's probably quite supportive to gold, right? So I wouldn't get in the way of this gold rally now. Now that it's taken out 1860, the next big level is 1960, and if it can take that out, then the highs of last summer are obviously the next target after that. Yeah. Okay, so that is gold. And yeah, and then just general other commodities, yeah, nothing too hot or exciting. I mean, they're consolidating a bit, chopping around. Copper's chopping around a bit after bouncing off sort of, where are we? had that pullback to kind of 445 and bounce, but nothing too spectacular. You've had wheat, decent pullback, bounced off there. Same sort of story with corn. So they're chopping, right? They're chopping around. Like I said, I wouldn't be too excited about these just yet. I'd look for another down leg. Often when you get this explosive, impulsive move to the upside, if you think about it in Elliott Wave speak, I've got a video on Elliott Wave on my website if anyone wants to, or on my YouTube as well if you want to learn about it. But basically, that type of move in corn from 16 to 23, clearly some sort of third wave. And often after a third wave, you get a fourth wave correction. And that fourth wave kind of takes a bit of an ABC type form. And right now, I would suggest that we've had the A, we're kind of doing the B, and the correction's not over until we see some sort of C wave back down, right? So I'd be more comfortable getting back into some of these commodities after I've seen what looks like a C wave to end that correction, which I don't think it's done yet. Yeah. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. I'd also encourage you to sign up for a free trial to our live and interactive Macro Insight Zoom call. As part of our trading community, as well as the call, you'll also get access to our Telegram chat and our weekly market reports. To find out more, you can also connect with us on the socials. All the links are at our website, www.options-insight.com. Thanks.